Gentleman yields back. Gentleman from New York, Mr. Torres, you're recognized for 5 minutes.
Thank you, Mr. Chair. I have a question about the intersection of the financial system and AI. Private credit, banking, insurance, and AI CapEx are becoming increasingly interconnected. The AI sector is experiencing the largest capital boom since the railroads of the late 19th century, and AI CapEx has become a disproportionate driver of both economic growth and equity market performance. To what extent do you view the entanglement of private credit, banking, insurance, and multi-trillion-dollar AI CapEx as a potential source of systemic risk? I'll start with the Fed.
Well, thank you. As the entity responsible for financial stability in the financial sector, it's a very important question that you've just raised. And it's something that we've been watching very closely to see how the AI industry and its investment has been evolving. We've seen an increase in asset levels and their valuations over time, and it's something that we continue to watch, and we're definitely paying close attention.
So is that a yes? Do you view it as a potential source of systemic risk? Or?
Well, it's certainly one of the risks that we're looking at.
I have a question about the independence of regulatory agencies, and I'll start with the Fed. Do you see your regulatory agency as independent of the president or as a creature of the president?
The Federal Reserve is an independent, apolitical agency, and as long as we continue to be transparent in the work that we do and we're accountable to Congress and the public, I think that that should continue.
What about the FDIC?
The FDIC is defined by statute as an independent regulatory agency, but we have also always tried to coordinate our activities with other agencies throughout the government, and so that's something we continue.
But independent, okay. And Kua?
Statute says that NCUA is an independent agency within the executive branch. One way you could describe our independence is we're obviously not on budget. The shutdown did not affect us. We are not funded via appropriations. That is one degree right there of independence. But again, I concur with my colleagues. We've always coordinated with the White House, and they've been a big help this time.
The Comptroller, during your testimony, you spoke of your opposition to, quote, the weaponization of finance, which is a sentiment I share. You know, we've seen President Trump publicly order the Attorney General to prosecute political adversaries. If the president were to order you to weaponize finance against those same political adversaries, what would you tell him? Would you tell him, no, Mr. President, the OCC has an absolute policy against the weaponization of finance?
Congressman, thanks for the question. I'm not going to engage in hypotheticals. What the president has told me through an executive order.
Do you have an absolute policy against the weaponization of finance?
Excuse me?
Do you have an absolute policy against the weaponization of finance?
There's a presidential executive order that says that banks should not discriminate on the basis of politics, religion, or being engaged in a lawful business activity.
Okay. Capital requirements. If capital requirements were at 0%, there would be no safety and soundness. If capital requirements were at 100%, there would be no capital formation. And so the object of public policy is to find the best balance between the two, to find the Goldilocks level of capital requirements. Like, what is that Goldilocks level, and how do you determine that level empirically? And I feel I have not heard a satisfactory answer to that question from either side of the debate. You know, your predecessor insists that the system is undercapitalized. You seem to believe it's sufficiently capitalized. Like, what's the objective empirical standard against which those competing pronouncements are being made?
The statute's direct definition for different sizes of banks is well capitalized. So that's one measure that we can use. We can also look back at the capitalization of the banking system prior to the great financial crisis in the aughts and determine that that clearly was not the right level of capital in the system. So the work that was done as a result of Dodd-Frank clearly improved the levels of capital and liquidity within the banking system. It more than doubled the levels of capital, and liquidity is very strong.
Is there a specific number?
I don't know that we know a specific number, but we are working to achieve a review of our capital requirements in a way that allows us to assess the risk that certain activities present to the financial system or the banking system.
And I want to quickly ask about, there's been public reporting that the Federal Reserve is planning to cut Supervision and Regulation Division by 30%. As you know, the story of SVB was partly a story of supervisory failure. If my constituents were to ask me, Congressman, why on earth is the Federal Reserve cutting supervision by 30% following the supervisory failures surrounding SVB, what should I tell them?
Well, Congressman, that is an excellent question, and I really appreciate the opportunity to clarify that. So when we're talking about reorganizing, we're talking about the staff at the board. Before the financial crisis, we had about 200-ish employees at the board. None of them are actual supervisors. They coordinate the activities of those supervisors that are resident within our 12 reserve banks. We're not talking about what we're doing with those supervisors, so they're completely separate.
Gentleman's time has expired.
Thank you, Mr. Chair.
I'd love to provide you with more detailed information on our